This is the Do-It-Yourself Guide to Business Buying. Today we're talking about financial analysis. Welcome, business buyers. What is our goal with this video, financial analysis? Well, we do financial analysis for two main reasons. Number one, to help us structure an offer that we can send to the seller. That's what we're covering in this video. But we also do it to identify red flag issues. We're going to cover that in the discovery video. We want to make sure that we want to actually buy this business. So what financial information do we need to structure an offer? And what analysis is needed to produce it? That's what we're going to cover in this video. So I want to go through the agenda. We'll look at review and confirming add backs. We'll look at EBITDA trend analysis, profit tracking. We're going to look at assets that we can borrow against. We'll look at the debt service cover ratio or the payment cover. We'll take a look at working capital requirements, and we'll take a look at quality of earnings. Obviously, in a fairly short video, we can't get into super low-level details on every one of these, but we'll give you a real good feel for what financial analysis looks like. And financials are also covered in other steps in the Do-It-Yourself Guide, like discovery, valuation, etc. We need earnings to value the business, and we need an earnings metric, which is going to be EBITDA. So let's start here by defining EBITDA. EBITDA, earnings before interest, tax, depreciation, and amortization. So we have to start with earnings from an income statement. Then we're going to make adjustments to that earnings number. That's going to give us EBITDA. Then we're going to use EBITDA to value the business using comparables or what other similar businesses have sold for. Now here's an income statement. Hopefully you can see it. I wanted to reproduce an actual income statement. Total income on an income statement really means revenue or sales. Sometimes people ask me about that. They look at an income statement and they're looking for the revenue number. Well, revenue is total income. Gross profit is what we get when we have revenue and we subtract cost of goods sold. Next, we have net ordinary income, where we deduct the operating expenses from the gross profit. And finally, we get net income, which is the final number, which includes everything. Well, which one do we start with when it comes to calculating EBITDA? And the answer is we start with net ordinary income. It's sometimes called net operating profit, sometimes called operating profit. We know the E in EBITDA stands for earnings. So which earnings number do we start with? That is net ordinary income. And so we start there, and then we determine if interest, tax, depreciation, or amortization have been deducted to arrive at that net ordinary income number. And if they have been, we add them back. So let's start with the $1,978,455. Plus, as we just mentioned, we have to add interest. So what we do there is we go to the expenses and we just run our finger down the page looking to see if there's an interest expense. In this case, there isn't. So we put interest at zero. We do the same thing for income tax. We don't usually find income tax in the expenses, so we're not expecting to see anything. And of course we don't, so that's a zero as well. Next, we take a look at depreciation, same exercise. But this time we stop because we do see a depreciation expense. It's $208,886. And so then we add that back. We add it to net ordinary income to come up with EBITDA. And then the final one is amortization. And when we go through the list, we don't see an amortization expense, nothing to add back. So we take net ordinary income, we do all the add backs, and that equals EBITDA, which in this case is $2,185,341. And we're going to use this number to work up and structure our offer. But first, we have to ask, when it comes to that net ordinary income number, is that a good number? Is there anything in that number that we need to adjust? On the revenue side, is that number good? Anything on the expenses side? Are those numbers good? It's very typical in these small businesses to see situations where revenue or expenses are either understated or overstated. It's quite common. And so we have to go through some kind of a review to check to see if there's anything there. And that's why adjustments are needed. We want to exclude non-operating revenue and expenses that don't belong in an income statement, but we also want to include necessary operating revenue and expenses that do need to be there. And we can come up with examples from both. Now, this is not something that's typically required in large and mid-market companies, but it is very commonly required with small and medium businesses where a lot of times personal expenses are run through the business. So if we have EBITDA, we do need to make some adjustments to come up with adjusted EBITDA, which has several different names. Sometimes people call it recurring EBITDA. Sometimes it's called normalized earnings or even sustainable earnings. It goes by different names, but it means essentially the same thing. And to avoid confusion, I want to explore the nuance between different metrics just to make sure it's clear in your mind. So we'll look at EBITDA, adjusted EBITDA, and SDE. SDE stands for seller discretionary earnings. It is an earnings metric that you find very often in the buying and selling of businesses. So let's see how it works. We start with net ordinary income, as we did in our example. And as we just went through the process of doing, we add back interest, tax, depreciation, and amortization to go from net ordinary income to EBITDA. Once we're at EBITDA, we add back personal, discretionary, and non-recurring expenses to come up with adjusted EBITDA. Now, there's one final adjustment for SDE. If we're going to calculate SDE, we add back the total owner's compensation as well, and that gives us SDE. SDE is a metric used to reflect earnings in fairly small businesses. There's only a handful of people. As we go up market, we typically are going to focus more on adjusted EBITDA. However, there are industry multiples that we can check for adjusted EBITDA to see what similar businesses sell for. And there's exactly the same thing for SDE. There are also industry multiples available for SDE that we can also check. But we do have to make sure that we apply the right multiple to the right metric. Let's take a look at our agenda, starting with the first item, review and confirm add backs. I want to look at some examples. We just took a look at the progression from net ordinary income to adjusted EBITDA and SDE. What we're taking a look at in this video is moving from EBITDA to adjusted EBITDA and the add back of personal, discretionary, and non-recurring expenses. Let's start with personal expenses. They are run through the business very frequently. This is not something a new owner would have to incur if they bought the business. So the existing owner's personal expenses run through the business, if they're legitimate, are definitely something that need to be added back to come up with adjusted EBITDA. Now, in a lot of cases, a portion is legitimate and the remainder is the owner's personal expense. I'm thinking of a company car. General manager, as a non-shareholder, would need a car to carry out their job responsibilities, but the current owner has a lot more car than is necessary. Maybe it's a luxury car, so maybe a portion of it would be a legitimate business expense, but also a portion that represents a luxury surplus that should be added back. Vacation and travel, same idea. And don't forget to include family members. We have to separate out business and personal travel, of course, is an add back. Same with insurance, whether it's life, health, and auto, including family members. Sometimes that's surplus of what's actually needed, so it's a legitimate add back as well. And of course, above market salary and bonus, including family members, are also examples of kind of personal expenses run through the business. And if they are run through the business, they are legitimate add backs. Discretionary expenses are not necessarily personal, but they're also run through the business, not something a new owner would incur. So if they're legitimate, we add them back too, like charitable donations. They're unrelated to the business. It's a pet charity of the existing owner. You're not going to be making those same charitable donations, so you add that back to calculate adjusted EBITDA. And other causes that are supported by the owners as well that are unrelated to the business, also treated as discretionary expenses and if legitimate, added back. Now let's take a look at non-recurring. They're slightly different than discretionary and personal, but they're also run through the business. A new owner wouldn't incur them on a regular basis, so if they're legitimate, they also get added back, like business interruption expenses associated with weather, disaster, accident, litigation expenses that are related to the business. So it's perfectly okay to add those back as well to get a true picture of the profitability of the business. Now, brokers will very often include add backs in the confidential information memorandum that you receive, and they can be pretty aggressive. And so sometimes they add back things that I wouldn't consider to be legitimate add back type items. So an analysis has to be done in terms of yes or no, whether they are or are not legitimate add backs. We've talked about some of the ones that are, like an owner's salary over market, owner perks, charitable donations, over market rent. I didn't specifically mention that, but that is also legitimate. If because they own the building and they're paying themselves more than the market rent for that, that is something that can be added back for adjusted EBITDA. But they have a tendency to include things that shouldn't be added back, like the owner's market salary. If we're doing adjusted EBITDA, there has to be a salary for the person running the business. Bad debt is a favorite add back. They can't collect the money, and somehow or other they think that's an extraordinary item. They want to add it back for the purposes of calculating adjusted EBITDA. That's a no-no. Even bad business decisions, very often, I mean, dozens and dozens of times I come across examples. Somebody goes to a conference and spends $40,000 and said, it was a waste of time. We're never doing it again. So therefore, we're going to add it back when we calculate adjusted EBITDA. No, that's not how it works. Bad business decisions aren't legitimate add backs. And a sale of an asset as well is not a true add back and shouldn't be included in your adjusted EBITDA. So that's review and confirm add backs, a super important part of the process of financial analysis. We'll have more to say on that in future videos. Now we want to take a look at EBITDA trend analysis. It is common for sellers to groom their business the year the business is being sold. So you'll find that they're having a banner year or their best year yet just happens to be the year they're selling the business. In that case, we do need to make a trend adjustment. I want to take a look at trends in general because we see different situations. We might be looking at a target company with declining EBITDA. Maybe the EBITDA is variable and bouncing around. Could be the EBITDA is growing steadily. Or we could be in a situation where the EBITDA is sort of banner year reported, which is things were bumping along and all of a sudden we have a year that's 2 or 3 times the best year they've ever had. In this situation, what EBITDA number do we want to use to plug into our valuation formula if we want to value the business? Well, I don't think we get the same answer for all of them. Declining EBITDA, my tendency is to just use last year only. That really reflects the new reality of the business, so that's my approach. If it's variable EBITDA, I'm inclined to take a 3-year average. If it's growing EBITDA, I can't just take a straight average. That penalizes the fact that this is a growing business. So I might take a 3-year weighted average with the weight more heavily oriented towards the most recent period. And of course, if there's a banner year EBITDA situation, you take a 3-year average, not as an automatic sort of knee-jerk reaction. I would say no. I'd say there's no set formula. It really depends on several factors, really for all of them. We need to understand what drives underlying variability in the EBITDA number. And so that's what we have to take care of when we're doing EBITDA trend analysis. Now let's take a look at profit tracking. If we look at profit tracking, let's start with revenue. We subtract cost of sales. That gives us gross profit. We deduct operating expenses from that gross profit, and that's what gives us operating profit or net ordinary profit. And that is a key number. The problem is it's subject to so many adjustments to get adjusted EBITDA. Why? Because it's affected by the personal expenses that are run through the business. And if there's a bloat of those personal expenses, it's going to affect comparisons that we make with other businesses, or maybe even with this business from period to period. So very often for comparison purposes, people use gross margin as the profitability metric. Why? Because it's pretty rare to have personal expenses run through cost of sales. So we're getting a more pure and isolated look at profitability through gross margin. And of course, gross margin is just gross profit divided by revenue times 100. And if we pick up the numbers from our income statement for gross profit, we put in 5,230,794. We divide that by the revenue, which of course is 5,796,660. Multiply that by 100, we get 0.902 times 100, or a gross margin of 90.2%. And now we've got a number that we can compare with similar businesses to determine its profitability. We can also compare this business over multiple time periods to see if gross margin is getting worse or getting better. And if we do that, we can see that in 2019, gross margin was 81.8%. It bounced around a fair amount in 5 years. The 5-year average is 86.5%, but the most recent year, the year the business is for sale, is 95.7%. So are we in a situation now where people have been trying to groom the business for a banner year? That's what financial analysis is designed to do, is to pose these questions and then prompt us to take a closer look. To definitively answer the question, of course, we would need to what? Understand what is driving the variability in gross margins. So this is an indicator reporting that there might be a potential issue here. It's not giving us the answer. The answer requires a little bit more digging. But that's taking a look at profit tracking. Next, we can look at assets to borrow against. So if we take our balance sheet and take a look at the current assets, we'll see things like accounts receivable, $212,397, inventory, $98,553, fixed assets, $174,009. Of course, fixed assets is not a current asset, but it's still an asset we can borrow against to potentially raise a closing payment. So what are the issues? Well, issue number one, these are book values. It's either an accounting book value or a tax book value. And of course, lenders don't lend against book value. They lend against the fair market value of the assets. So the 3 questions we need answered are, number one, is it accounting or tax book value? Tax book values especially often greatly understate the fair market value. But we have to find out what is the fair market value of these balance sheet assets. And then finally, what is the loan to value ratio that we can use in terms of how much of the value of the asset can we actually borrow? So let's take a look at those. Fair market value of accounts receivable is only $199,852. Why is it smaller? Because we deem some of those receivables not to be collectible. Maybe they're over 90 days or 120 days. Whatever your cutoff point is, in terms of collectible receivables. Inventory, 72,000. Yeah. The difference between the two numbers might be obsolete inventory. Fixed assets, this time it's more. Maybe the fixed asset book value of 174 was a tax value, but the fair market value is quite a bit higher. So we need to make the adjustment between the book value to the fair market value. Once we've got the fair market value, we got to figure out how much can we borrow against that asset. And of course, accounts receivable, if they're all good, and we've already made the adjustment to make sure they are good, good means collectible, where the money's only been outstanding for a short period of time. Yeah, we might be able to borrow up to 85% of that number. Inventory typically tends to be a lot lower, and there's different categories of inventory that have different loan to value type ratios. I don't want to get into that level of detail here. Let's say in this case, it's about 35% of the value of the inventory that we can borrow against. In terms of fixed assets, depending upon the category of the fixed asset, the loan to value ratio will change. Let's use kind of a median value of 50%. Now we can calculate how much money we can actually raise. For accounts receivable, 169,874. For inventory, 25,432. Now I have to say that borrowing small amounts against inventory typically is only done when it's part of a bigger sort of borrowing amount. So it's kind of an add-on amount. If we're only borrowing against inventory and inventory alone, it tends to have to be a lot bigger number than that to attract inventory financing specialists. We'll get into that when we talk about finding the money. In terms of fixed assets, 50%, 161,945 total, 357,251. What does that number represent? Yeah, it really represents what we can potentially raise for a closing payment. So we want to definitely take a look at the assets that we can borrow against when we're doing our initial financial analysis on the target business. Next, debt service cover ratio or payment cover. We really want to answer these questions when we're looking at payment cover. Will future earnings be enough to pay principal and interest on acquisition debt and other existing debt? And how big should that cushion be? If we're taking a look at future periods, look at what money is coming in, what money is going out, and then making sure that it's over one, because that's what's going to be required to stay solvent. And we want to know, is there enough of a cushion? If we're at 1.5, is that enough? Do we need to go to 2? Is that enough? Now, having said that, it'd be pretty hard to find a max leverage LBO type situation where you have a payment cover greater than 2. Not easy to find. In terms of the money coming in, where's that number going to come from? Well, we could do a bottom-up detailed forecast. And in fact, we probably will do that in due diligence. But on a first pass, we'll probably use a more top-down number and just take a look at existing historical adjusted EBITDA to determine how much money we believe is going to come in for the purposes of calculating debt service cover. In terms of the money going out, that's just total debt service. That's all debt, principal, and interest. So for future periods, we'll be taking a look at the adjusted EBITDA over the total debt service. We want to make sure that's greater than 1.5. And if it is, we're in good shape. And that's really all we need for initial screening. We'll do a detailed forecast when we get to due diligence, but that's debt service cover ratio, definitely an important part of the financial analysis. Another item we're going to take a look at in financial analysis are working capital requirements. Let's start with the balance sheet here as well. This time we're going to take a look at current assets and current liabilities. On the asset side, we have cash, of course, accounts receivable, inventory, total 416,841. If we take a look at the current liabilities, accounts payable 138,796. We have other accruals together are 77,987. Taxes payable 60,432. Total is 277,215. It is possible for both current assets and current liabilities to have different accounts in there, depending upon the circumstances. But the point is the working capital, or the net working capital as it's sometimes called, is the difference between them, between current assets and current liabilities, which in this case is the 416,841 minus the 277,215, and that's what we call working capital. It's 139,626 in this case. And we have two interests in working capital. The first one is trying to understand the yearly min-max range for the fiscal year. What is the fluctuation in working capital over the course of the year? Working capital is an asset. It has to be financed. And of course, we're also interested in understanding what the closing balance is going to be for net working capital. And we want to peg what that's going to be ahead of time in our letter of intent. In fact, that's one of the biggest challenges to closing a deal is getting agreement on the peg value of the working capital. We're going to take a look at closing balance peg value in future videos. In this video, we're taking a look at the yearly min-max range. So if we take a look at the 12 months of the year, let's say the fiscal year, in this case is the calendar year ending in December, and here's the working capital. If we take a look at December, we just calculated that number to be what? 139,626. But we also need monthly balance sheets for every month of the fiscal year for the previous 12 months. Why? Because we want to see how the working capital fluctuates. So we take a look at November and October, and we work backwards. And we determine and note the balance in each month. For the purpose of doing what? Finding out what the min is and finding out what the max is. And the min-max range in this case is between, say, 70K and 165. It's a rough estimate based upon visual inspection of the graph, right? But the min-max range is 70 to 165. So we are potentially going to need 165,000 in working capital at some point. And working capital is an asset like all the rest of the assets we have in our business, and it does need to be financed. So that's why we're undertaking this analysis, is to see what our working capital requirements are going to be. And so min-max range we took a look at here. Like I said, the closing balance and the peg value, we're going to cover it in the video on structuring the offer. But working capital requirements are an important part of financial analysis, no doubt about it. And finally, let's take a look at quality of earnings, which is a thorough examination of all components of a company's earnings. We want to determine the sustainability of those earnings. Basically, we want to take a look at the earnings and make sure they're real, and it's not just a show that someone's put on for our benefit to try and help sell the company. So I want to take a look at the top 10 quality of earnings issues. A lot of the things that I've talked about in this video, we say we have to take a deeper look. Yeah, quality of earnings is part of the process of taking that deeper look. The big one, I think, or the one that we always start with, is revenue recognition. There's many issues associated with it. The problem is very often companies will recognize revenue before earning it. To earn revenue, you have to deliver the goods or services that the customer purchased. But if people get a deposit from a customer, instead of putting it on their balance sheet as a liability, if they flow it through revenue right away, you're going to get a mistaken picture of what's going on with that business. They can manipulate the cutoff periods. Instead of cutting off revenue recognition at the end of December, if that's the fiscal year, they extend it by a couple of weeks into January just to make the numbers look a little better. They don't push forward the expenses side of it, but they do the revenue. And of course, having the customer deposits or deferred revenue missing on the balance sheet as liabilities also distorts our view of the financial position of the business. Next, earnings manipulation. Where you delay discretionary expenses, you put them into a future period just to make earnings look good for this period. Sometimes you dip into the cookie jar reserves, as they say, which is when you take a reserve against certain aspects of your business, whether it's warranty, bad debt, whatever it happens to be, and then you manipulate that reserve number to make earnings look good in a particular period. Or they practice big bath accounting. What does that mean? It means you take a big bath and you concentrate all of your expenses into one period, show a horrible earnings for a specific period, and then that makes earnings in future periods look a lot more favorable. Sometimes inconsistent financial policies are an issue. We got to check them. They change the depreciation method to make earnings look more favorable in a given period. Maybe switch inventory valuation methods, LIFO, FIFO, average, etc. Switch provisions for estimating reserves. All of these things are possibilities. We should take a look at them as part of our quality of earnings report. Next, we want to take a look at related party transactions. These are undisclosed transactions between parties that are related that we don't necessarily know are related. Sometimes transfer pricing between them happens at non-market prices, which can distort our earnings. Sometimes undisclosed guarantees on liabilities and debt are part of the equation, but we're not aware of it. So whenever we're doing quality of earnings, we always need to take a look at related party type transactions. Bloated inventories. Overstating inventories by delaying write-offs. So the balance sheet looks healthier than it really is because we haven't written off inventory that we can't actually sell. And so those inflated asset values will impact our ability to get an underwriter to underwrite the loan because of a discrepancy between inventories we're reporting and the real inventory value. And overstating inventories can also mask solvency issues as well. So we have to keep our eye on that. Non-recurring items like gains from the sale of business assets, that's not part of recurring revenue and income. Sharp price swings in commodity prices. You're a lumber yard, you've got some inventory that you bought at a low price. There's been a sharp upward swing in the commodity price, and then you sell it. Then obviously you're having huge gains based upon commodity price movements rather than simply operating profit. And sometimes costs related to legal disputes, settlements, or fines are also something that has to be taken into consideration in terms of whether it's a ongoing expense or a one-timer. Inadequate reserves, I've already mentioned this or touched on it. Inadequate provisions for bad debts, we let that get really thin because we want to try and goose our income in a specific period. Inadequate reserves for warranty claims, inadequate reserves for legal disputes and settlements, which are necessary in some kinds of businesses. Cost deferrals, where we shift current operating expenses to a future period. One way that we do that is we capitalize expenses, which allows us to inflate earnings. If we're working on software and we have all these developers, we incur all of these costs instead of flowing them through our income statement. When they occur, we capitalize them, turn them into assets, and then we depreciate them over their useful life. And that's a way to take the expense and push it into future periods. Sometimes that's legitimate. Sometimes liberties are taken. This is a quality of earnings analysis, and that's one of the things we take a look at. Sometimes people just delay maintenance and repair costs and those kinds of things. So that's worth exploring as well. Overvalued assets like inventory that can't be sold and goodwill that should be impaired but isn't, and receivables that are not collectible. Remember, a lot of times we're looking at balance sheets that have not been audited or reviewed. We're simply relying on the credibility of the business owner or seller who's preparing those documents. And so taking a look at their assets and seeing if they should be impaired or written down or written off and haven't been, that's something that has to be factored in to the offer we make on the business. And number 10, unsustainable margins, where they've done unsustainable cost cutting just because they want to goose that income number. CapEx has fallen behind. The asset base is old and frayed. They haven't been keeping it current because they want to maximize the earnings before they sell the business. And like I said before, taking a buy or sell side in a commodity business is one of the ways that we can see big impacts on profitability that really aren't related to the operating business. So that's financial analysis. We can outsource all of this to a financial expert, or you can do it yourself. But either way, you do have to understand the financials and have some comprehension of what's going on if you want to ensure that you're going to make a successful acquisition. It's totally possible. Let's get out there and get after it. This is the do-it-yourself guide to business buying. And today we've been talking about financial analysis because we always want to learn and grow as we go. Thanks for watching. We'll see you next time.